All right, folks. So this is what one of the disclosure statements look like. And notice they call it a detailed roll forward for all the uncertain tax benefit reserve. So you start with a balance, provisions for the current year, additions for prior years, any changes in judgments that you've had, settlements that you've agreed to, lapses of statute, things like this. And there's your current balance here at the end. This is where your balance is at the end of the year. Okay? So, a couple things to know. All of these liabilities, all deferred tax assets and liabilities, are considered non-current on the balance sheet, which makes sense because they're not going to be settled in the current year. So that makes sense. And notice, does not permit netting of deferred tax assets and liabilities that are to different tax jurisdictions, federal, state, or foreign. So in other words, state with state, federal with federal, foreign with foreign. You can't mix and match. Okay? Then there has to be a lot of footnotes. Notice here, extensive footnotes, disclosure to provide transparency. By the way, this is mainly for analysts. Those are the folks that are always using it. Wall Street types here. Okay. And valuation allowance, details about that, balance sheet components, all the components, you have to talk about it. And then down over here, publicly traded companies must disclose the approximate tax effect of each temporary difference. Okay. So pretty significant notes go along with this. Okay. Some other items they have to talk about are the current tax expense benefit, any deferred tax expense, carry forwards, net operating losses, tax law changes, value allowance changes. So these are all in the notes. And if you have ever seen a publicly traded company's financial statements, you know the notes are pretty long. Okay. And then the next thing they have to do, so the U.S. statutory rate is 25%. And we need to know, they also want to know what is the effective tax rate? Effective tax rate. Okay, so not all companies wind up paying this 21%. Okay, they could wind up paying less depending upon what's going on with their books. Not just it could have to do with assets and liabilities and these deferred tax assets and things like this. So 21% statutory, but now what changes are going on? Okay, so basically, if you take your total tax income provision divided by your pre-tax book income, this gives you your effective tax rate. Okay, all right. Notice, investors and analysts closely monitor this rate. Okay, and notice they know how efficient is a company with their tax strategy. Okay. And then cash taxes paid versus pre-tax book income. Okay. Another way that they take a look, analysts look at it to decide how well a company is working its tax strategy. All right, folks, that's it. End of chapter 7. I know it's 17, some complicated stuff. Read through this stuff, study this. I'm sure you'll be fine. And by the way, don't worry, when you get out of school, they're not going to have you do this right away. This is pretty heavy stuff. Talk to you soon. Bye-bye.